Hello, everyone, and welcome back. My name is Greg Furman, and this is the Vantage Point AI Market Outlook for the week of November the 1st, 2022. Now, to get started this week, we're going to begin where we always do with the US dollar index, but our main focus in this week's presentation will be the US dollar index and the S&P 500, the inverse correlation between these two going into a very volatile week with the non-farm payroll, the Bank of England, and of course, the U.S. Federal Reserve's rate decision. Now, there's a lot of disinformation, misinformation going on around this regard to this rate hike from the FOMC. The Fed has been very, very clear. Jay Powell has been crystal clear and has reaffirmed multiple times that their 2% inflation target and they're going to do whatever it takes. They have not talked about pivoting. They have not talked about changing policy going through 2023. They're talking 2024 before they look at cuts or things of this nature. So the media and some of the pundits in the media are spinning this out of control, which is causing a lot of volatility when the Fed has not stated anything about the latter of pivoting, etc. So we are at the mercy somewhat this week in a very volatile week. So let's look where we're at right now. The dollar had a pretty decent rally on Friday, but here's the main indicators that we need to look at. The MA diff cross has crossed to the upside. The medium term trend is weakening. We remain locked in the current channel, and that channel goes down to the about, you can notice here, I'll say September the 20th is where we've got a low put in for the dollar. We can see that we hit that exact same low on the verified support indicators in Vantage Point at 109.53. We are now starting to turn back up. We are firmly above the yearly opening price, and the dollar is in a very strong uptrend. We remain locked in this channel for now. The neural index has turned positive. The neural index strength has turned possible, or has turned, positive. But again, this is warning of a reversal back to the primary trend, and this move lower on the dollar is corrective in nature. Now, when we take the main inverse correlation that we've worked on and that we know to be factual, dollar up, S&P 500 down. So when we look at the same signal, we can see we have an MA diff cross to the downside. We are firmly below the yearly opening price, the S&P 500 in a significant downtrend on the year. So again, we're hitting into the same verified resistance, this one on September the 21st. This is warning that the S&P 500 will likely rally at the beginning of the week and then a violent reversal back to the primary trend, because again, some of these pundits out there that are talking, they're putting words into the Fed's mouth that the Fed has not stated. He's actually said the exact opposite. So now they're feeling the heat or the pinch, these hedge fund managers, with the stock markets constantly selling off. So again, I cannot predict specifically what the Fed is going to do here, but until he pivots, then there's no reason for us to pivot. We would stay with the primary trend, stocks down, dollar up. So that is the primary basis through this presentation this week. Now, if we look at things like light sweet crude oil, they're obviously getting a boost from the stock market, but even that is a very soft bounce here, and the indicators, they're starting to roll over back down to the downside on light sweet crude oil. Another warning sign that the dollar is getting to ramp up. Now, the other thing I will, on a side note, I will say is that if we bring in seasonalities of the dollar, the month of November is a very strong month for the US dollar. Not to mention, we have the dollar cycle where there's real dollar demand at the beginning of the month. Now, December is a horrible month for the dollar, but we're a month from that, guys. Okay, so when we look at this right now, oil remains also in a very strong uptrend this year, but we're starting to go sideways here. So again, warning us, this may not be what it appears to be. Now, if I again cross-reference this to Bitcoin, Bitcoin has had a bit of a rally up, but we're still locked into this channel. and Bitcoin predominantly is not overly strong by the middle of November. So we've had a decent rally this month in Bitcoin. It still remains very firm above 18,000. So things still look good, but Bitcoin and the S&P 500 and the Nasdaq, I'm going to argue, is the same trade here, guys. I've shown that at the seminars. I've split the screens. If stocks go higher, Bitcoin goes higher. I just don't think that that's this coming week. I think that both the stocks will start moving back down, Bitcoin likely to follow until we get towards the end of November. The indicators are definitely overbought on this, but again, just because something was overbought doesn't mean it can't go higher. Now, when we cross-reference this to gold, we can see that gold is simply unable to get any buyers whatsoever. When we look at this, we're banging into that T-cross long. Our key resistance for gold this week, I don't anticipate a great week coming. The next 7 to 10 days, likely not that good for gold here, despite the fact of a possible recession. We've had multiple failures along the T-cross line, 1660, moving lower on Friday on the dollar strength. These indicators are warning that gold is getting ready, that momentum is building to the downside, and this would again point us potentially towards dollar strength. Again, when you're looking at two heavyweights here, like in a boxing match, and if we look at, if we take the Vegas odds, for example, we look at the tail of the tape. So when we look at it, the tail of the tape here, it's heavily favoring the US dollar. The only one that can change that outcome is a Fed pivot. So we'll be watching this very closely, but for now, again, the warning signs is that these moves are indecision, the media spin ahead of the Fed. When again, just remember Jeremy Siegel, for example, does not work for the Federal Reserve. He's been very opinionated lately. This is an index trader. He has very minimal experience on month to month, year to year trading. Index fund traders or investors, they simply buy and hold here, guys. And I don't think we're in a buy and hold market right now. So when we look at the bringing in some of the additional currencies to assist us with what's likely going to happen, we can see that the euro had a bump higher on the ECB, but the ECB, much like with Apple and Amazon of last week, they're painting a very dire picture. So while the earnings may have beat expectations slightly, not by a large margin, but what they're basically saying, the outlook doesn't look great here. Sales are slowing, recession likely on the horizon here. So the ECB statement basically confirmed that. Lagarde was more dovish in my respectful opinion. So the euro correcting still firmly below our verified resistance high at 101.98. We couldn't even get to that this time, and it's turned lower. So when we look at the indicators on the euro currency, the euro US pair has a 99.85% inverse correlation to the dollar index. We can assess in the VantagePoint software, it's warning that the euro is getting ready to turn back down again. So if we get a Fed that's willing to tackle the media and say, I didn't say any of these things. You guys said that. I told you. I've reaffirmed to anybody who has asked me, 2% is our inflation target. We are going to continue to hike. That's it. So again, until we get that statement, the euro should come under pressure by midweek here, if not sooner. Remember, Monday is largely a fake trading day. So if you see a big rally on stocks on Monday, you should expect a significant sell-off on Tuesday. The same as if you rally on the euro up to the upside on Monday, you should expect a sell-off on Tuesday. Now, the T-cross long, 98.67, I do anticipate if the Fed remains on track or on target for what he said, then that would likely send the euro significantly lower. Now, we could see buying opportunity on pairs like US Swiss franc. You can see that I've got this stacked in here. The yearly opening price, 91.09, the monthly opening price at 98.72. We can assess we've come down to that monthly opening price and now we're turning higher. So potentially some good buying opportunity on this pair at the beginning of the month because again, the seasonal pattern on the dollar is extremely strong in the month of November. It's actually one of the strongest months of the year next to that first quarter. So keep an eye on this, but the indicators are definitely pointing higher with this particular pair. Now, with the British pound, US dollar, once again, it's had its rally, it's had its fun. There's been a rebalancing here going pre-Fed, but again, this is a lot of media spin. Things are not great in the UK. Now they've pushed off their financials for, I think, another week or something. So we've seen this movie before, guys. The probability that the pound fails here, we have a verified resistance high at 117.30. We're not breaking through that particular level right now. The indicators are warning that this pair too is getting ready to turn. But as you can see from Friday's price action, if the dollar index is going up and the S&P 500 is going up on the same day at the same time, one of those two is not a true price. And most things are pointing that stocks is a false price. If that's the case, then the pound with the euro is likely to head lower on dollar strength by midweek. Now, again, if we're looking at this from the dollar yen standpoint, rumors somewhat squashed that now the Bank of Japan is saying it was just a rumor that they intervened. But this is, again, guys, media spin. This is, you see what they do is they tell you things, or they put things out there, or they start a rumor, much like what they're doing with the Fed right now, when there's no way of validating it, right? And if it doesn't come from the horse's mouth, then it's just opinion. That's all it is. So the rumor has it now that the Bank of Japan's intervention was just that, a rumor. So somebody started this rumor. Could be the Bank of Japan, could be the Fed, could be anybody. But right now, this is warning that the dollar yen is getting ready to move higher again. In my respectful opinion, I hope the Bank of Japan gets punished for their intervention, because every time these central banks have intervened in the currency market, it has been a complete and utter disaster. So again, free market, it will sort itself out. The Euro Swiss franc debacle several years ago with the Swiss National Bank and the euro, the best example I can give you of disastrous central bank intervention in the currency market. So again, right now, if we can get above our Vantage Point T-cross long 147.09, this pair does have room to run, especially going into the Fed. Remember, this pair by definition is the carry trade. As the US continues to hike, Japan has said they will not hike. They're keeping with negative rates. So the interest rate differential between the US and Japan continues to widen, again, strengthening the carry trade. They're using Japan as a funding currency. That's it. They buy dollars, they sell yen, they get paid to do that. They get paid swap every day times three on Wednesday for this. So again, if we can get back up over our T-cross long at 147.54, there's a very strong possibility that we move back to the October 21st high, which is still very recent at the 151.94 level. Now, as we move into our main equity-based currencies, starting again with the US CAD, now the Bank of Canada's position is starting to soften a little bit. So once again, you can see the power of using the verified zones. 135.01 is a verified support low. This is not a coincidence, guys, that we couldn't get through there 2 days in a row. So even though you could have a crossover in the software, the verified zones are saying, look, we've got major support here. So which is right now, if we look at the tail of the tape, going back to that Vegas odds, the dollar versus the equity, the tail of the tape favors the dollar, then if equities drop, US Canada goes higher almost immediately. US Canada, as I talked about last week, has seen significant resistance at the monthly opening price. We've come lower, but we're basically trapped here, guys, between 135 and the monthly opening price, and that's coming in at or about the 138.16. So this is your current channel or range that you're dealing with. We buy the bottom, we sell the top. But if the equities remain in a firm downtrend, then that is going to push this pair potentially through the 138 level by possibly mid-month. So keep an eye on this one. But once again, when we look at the pairs that are inverse and mirror this, you can see that we have no buyers. Despite this apparent significant rally in the S&P 500 on Friday, if that was a true rally, then Aussie US would be going higher. It wouldn't be selling off the way it did on Friday. This is the needle in the haystack that we look for, guys, that's saying, okay, the intermarket correlations currently do not support the rally in the stock market. And because if it was, this pair would be going higher. We've come up to the verified resistance high. You can see that was on October the 4th, and we're failing. So now as we move into the 4th of November, this would again point towards another move lower on the Aussie US. We can assess that the New Zealand currency is doing the same thing. It's getting all tangled up on virtually the same day. This is virtually the same trade, guys. Aussie US, New Zealand US, there isn't a lot of difference between these pairs. So as we fail up here, a breakdown below that T-cross long would again suggest to me that this is getting ready for yet another move. We've got our MA diff cross, which is crossing to the downside. We see something very similar, more pronounced with the Aussie, warning us that, look, this is getting ready to go lower. And that medium-term trend weakening against the long-term trend is also visible here on the US-Canada. So again, trading is not about being right or wrong, guys. It's about doing the proper, thorough analysis and bringing in intermarket correlations to assist you in seeing, is this a fake move? Is this disinformation from the media saying that the Fed is going to pivot? Is all of this just a way of getting real retail traders going the wrong way? So with that said, this is the Vantage Point AI Market Outlook for the week of November the 1st, 2020.